Good evening, guys. Can we do a sound check just to let me know if you can hear and see my slide? If you can, just put something into the chat box so that I can see that you can see and hear me. Is everything okay? Can you see me? Can you hear me? All right, I assume you can because nobody seems to respond. So I assume that you can see and hear me. All right, let's get started. And this session is a special session in lieu of the weekly market wrap. Today, we're going to do a special on the US presidential election 2024 and how it may impact markets. Of course, to get started, let's acknowledge that the sponsor for this event is IronFX, a broker with operation in over 180 countries around the world. And they do offer something like 500 tradable instruments in OTC, FX, precious metals, shares, equity index, as well as commodities. And the presentation is obviously not an inducement to buy or sell any securities. And just be aware that the trading of any kind of margin financial products to carry risk of loss. You are all advised to seek professional advice before trading. And of course, I'll be sharing you my views on the various markets and what I think this election may bring. And just be aware that we will not accept any responsibility for anything that you may do right after this webinar. Okay, there's a couple of questions here. Chat is disabled. Okay, anyway, you can put your Q&A, your question in the Q&A. Thank you very much, Sam. Okay, now just be aware that today is the end of daylight saving, meaning to say tomorrow the market will open 1 hour earlier. So just be aware of this feature here. And you have to adjust your trading hours, especially in regards to the US markets tomorrow. And to start off the week itself, we have the ADP employment change. We will cover only the US numbers today because we are only specifically talking about the US election. Now, the number that came out was a lot better. In fact, it was almost double what the market was expecting. Previously, in the month of September, the ADP employment change rose by 143,000. That was revised higher to 159,000. Market expect only 115,000 for the month of October. It came in much, much better at 233,000. So this actually set the tone for the non-farm payroll, which came in at the disastrous 12,000 jobs created. Later on, I will explain why that is the case. And that was the first data that came out this week for the United States. And of course, we also have the GDP, the final revision for Q3. It was eventually revised downwards to 2.8%. Previously, we were told that it was 3%, and now it is at 2.8%. That did not obviously affect the market in any material way. The market took it in their stride because they were all waiting for the non-farm payroll numbers. Okay, then of course, we also have the inflation number. This is the Federal Reserve favorite inflation gauge. We have the personal consumption expenditure. You can see the chart on the right, on the left, which shows that the headline PCE number year over year is at the lowest we have ever seen, 2.1%, which is actually very, very good. The market wanted to celebrate this. However, when we look at the core PCE number, it came in at 2.7, unchanged from the previous 2 months. So that did not actually gels well with the market participant. And moreover, on a month-over-month basis, the chart on the right with the blue bars, you can see that the month-over-month numbers are actually edged higher to 0.3%, which is the highest since April of this year. So based on the month-over-month number and the fact that the core PCE number, which theoretically should be lower than the headline PCE numbers, was at 2.7%. And then month-over-month, we have a slight increase in the PCE numbers, and this did not sit very well with market participants. And we can see that on Thursday, we have a bit of a mini profit taking. And this actually exacerbates as the evening goes by. Later on, when we look at the chart, we can see that Thursday was a less than ideal day for equity players. And of course, a lot can be attributed to the fact that it is the weekend before the US presidential election. And all this come to a head whereby there were very evident profit taking place in the later half of the week. Okay. Then non-farm payroll, this is the big one. Of course, we are looking at these numbers, and the actual release of the non-farm payroll, the number of jobs created was at a lowly 12,000, but the market was expecting 113,000. And also worth noting is that the previous month, they released the number for September was 254,000. That was revised down to 223,000. And even for the month of August, they had revised it down to 78,000. Now remember the last month non-farm payroll, it was very, very good. And all the revision was upwards, including the August number. And now we see that the impact of the back-to-back hurricane in the Gulf states surrounding California and North Carolina, we can see that we have Hurricane Helene, followed very, very shortly by Hurricane Milton, which together actually caused a lot of chaos in the Gulf areas, and those areas definitely will not see jobs creation. However, in the months ahead, this could change dramatically because of rebuilding. And of course, we have the impact of the strike at Boeing. It looks like they may be able to come to some kind of agreement, but that will be at the expense of higher wages. We can see the strike at Boeing has taken out quite a fair bit of jobs from the manufacturing sector. We can see that manufacturing lost something like 46,000 jobs, of which 44,000 were transportation equipment manufacturing. And that means it's Boeing, okay? So we can see if they manage to get some kind of an agreement between the management and the union, these jobs will come back very quickly, and that may actually bump up the following month's non-farm payroll. Just be aware that despite the 12,000 that we saw for the month of October, this is an aberration. Once the rebuilding starts in the Gulf states, as well as the agreement between the union and Boeing, these jobs may be reinstated, and that would be good. Okay, and there are boxes on the presentation. What do you mean boxes? Let me see. Okay, if that is the case, I think there is a need to reshare this. Okay, is it getting better? Right, and then of course, like I was saying, this will be an aberration in the following months. I do expect non-farm payroll to come back very strongly as the strike ends, as well as the rebuilding in the US job manufacturing sector. Cool say there is still many boxes. Okay, what I can do is, you shouldn't be seeing boxes. That means you are seeing something else. Not sure what is that, but hopefully you can see better now. Anyway, let's continue. Let's not spend too much time doing this. Reshare the screen again. Okay, I can do that. Let me see if we can reshare the screen. Are you seeing better? All right, like I said, let's continue. Now today is the not today. Today is the weekend before the election day, and election will be on November the 5th, which is on Tuesday. So it will be a whole day affair. There are already advanced voting, and that should come in as the election gets into full swing on Tuesday. So on Tuesday, it will be very interesting to watch all the others and to see how things pan out. Okay. Please close all other windows. Let me see how we can do that. Okay. Right, hopefully we are back to where we should be. Now, as far as the election is concerned, there are two candidates, as you all know by now. There will be the former president, Donald Trump, as well as the Vice President Kamala Harris, and both, as far as the polls are concerned, are neck to neck. Not sure if we can trust the polls, because previously in the previous election, the poll was showing that Donald Trump was leading, but when the result was counted, he lost the election. So here we are again, 4 years later, and looking at the polls, and it seems to be both candidates are at neck to neck on as far as the polls are concerned. So this will not be a good indication as who is leading. But the markets, as far as I can see, is actually pricing in a Donald Trump win. Okay, and for all we know, at the end of the day, what matters to voters as far as the Americans are concerned is exactly what every election is all about. It is all about the economy. So whoever can deliver economic growth will be the one that voters want, as in all other elections. Here we can see that the economies actually dominate both parties here. We can see the patterns as far as the economy is concerned. The 52% of voters rated the economy is extremely important, and whoever have the better economic platform should be able to get more votes as far as you're concerned. But the Americans' voting system is very different. It's not by popular vote, okay? Donald Trump got the most popular vote in the last election, but he did not win because there is this thing called electoral college. The popular vote would normally carries the electoral vote, but the electoral vote does not necessarily have to vote according to the popular vote. So it's a little bit of a twist here. So at the end of the day, whoever is more popular may not necessarily be the one that's going to be winning. Okay, so it all comes down to the electoral vote. And here we have to watch the events as they unfold on Tuesday. But like I say, the important thing for voters in America is about the economy. And we have seen how the economy has been badly affected after the lockdown post-COVID-19. And that is still lingering in markets. And we can see that the wars in Ukraine has actually caused inflation to actually rise very sharply, although headline numbers has indicated that the inflation has more or less been defeated. But I beg to differ, because data are not necessarily what we are seeing as far as the inflation. I have reason to believe inflation may come rolling back again, because whether we look at Trump or whether we look at Harris, both candidates' policies actually will bring higher spending, which in turn will lead to higher borrowing. We know that U.S. national debt is now at $35.7 trillion and counting. And if both candidates' policies will lead to more spending and more borrowing, that means to say at some point we will have to contend with the biggest elephant in the room, which is how to deal with the U.S. national debt. Obviously, they cannot continue to kick the can down the road. At some point, they will have to address the real issue, which is how to deal with an exploding debt. And now we have the interest payment on this mountain of debts at $1 trillion per year, which is an unheard of number. Okay, so again, here we see as far as Donald Trump is concerned, these are his key economic agenda. He wants to impose universal tariff between 10 to 20% on all imports into the United States, whether they are from from China or from countries which they deem to be unfriendly. This tariff here will be imposed on all, regardless. So the 10 to 20% universal tariff is what Trump is saying that he will do if he returns back to the White House. Now, the other thing is that he will impose higher tariff on countries that impose tariff on Americans' imports. This means at some point who will be paying for the tariff. We have seen how tariff actually cause inflation, because at the end of the day, those tariffs will be borne by the consumers, which is American consumers. Okay, and here we're also talking about tariff, 200% tariff on some imported cars. I think they are looking at Chinese EVs. And this is definitely going to be something that we want to watch, because like I say, all tariff eventually will be borne by consumers, and that will be reflected in higher prices. And the other thing that Donald Trump wants to do is to slash red tapes. He wants to cut down on federal regulation, which make businesses a lot more friendly. So I think all said and done, on balance, I think Trump's policy seems to be business friendly. So if Trump actually come out ahead and actually win this election, the market may actually celebrate, because like I say, going into this election, going into this weekend, we saw that the market has been more or less pricing in a Donald Trump win, because we can see that in the equity markets, we can see in the dollar, we can see it in gold, we can also see it in Bitcoin. Now, Trump is also a first president to be actually tying himself to the cryptocurrencies, and I think he wants to use Bitcoin as some way to slash the national debt. Okay, so we will see whether that will be the case. Now, he wants to keep taxes at the minimum. What he wants to do is to maintain those tax cuts that he has stipulated during his first term, and he wants to reduce corporate tax further from the current 21% to 15%. This is definitely something that the businesses would definitely want to celebrate, and he wants to also end taxes on tips paid to service workers, and this is something that Kamala Harris has actually also mimic. She also harped on this non-taxation on tips. Now, Donald Trump also do not want to have any cut on Medicare or Social Security benefits or raise the eligibility age, because we all know the baby boomers are now seeing their benefits being cut. Maybe one way we can see that being cut is through inflation. We all know inflation is a form of taxation, and if they want to reduce the national debt, higher inflation definitely will be something that they may actually look at. Okay, so that is one of the reasons why I do not believe inflation is going to go away anytime soon. In fact, inflation is very much desirable if a country has massive amount of debt. Okay, and inflation will cause real income to actually go down, and it will also cause the overall tax burden to also be reduced. And he also wants to create something new here called a sovereign wealth fund to invest in infrastructure projects, mainly to build roads and highways. So we can see that is definitely a positive. Okay, unlike the Biden's what we call that, he called it the infrastructure bill, but there is hardly anything being built since then, okay? And he wants to end regulations on cryptocurrencies and to defend the right to mine Bitcoin. Like I say, he is possibly one of the first president to actually come out and say that he favors cryptocurrencies. So a win by Trump would definitely benefit all the equity markets. It would maybe also not necessarily do well for gold, because Trump is basically an anti-war guy. So if he managed to get into office, he claims that he can actually end the war in Ukraine within the first 24 hours of his office. Okay, so if that's the case, gold should actually come off, okay, not go up, because that means there will be less geopolitical tension, okay? And then, of course, Bitcoin will benefit in a big way, although right now we are seeing Bitcoin having failed to take out the all-time high, has practically been unraveling as we are speaking, okay? Now, on the other hand, Harris' agenda is very different. She wants to focus on raising taxes. She wants to increase corporate tax from the current 21% to 28%, and thereafter to 35%. So just this alone will mean that she will not be favored as far as the businesses are concerned, because it means higher cost of doing business. And she wants to increase tax on stock buyback from 1% to 4%. And she also wants those who earns more than $100 million to pay 25% of their income tax and their unrealized capital gain. Now, this is very controversial, because something that if you have not realized whatever earnings you have, the government wants to tax those as well. So this is something that is very, very unconventional and definitely not very popular. So based on this alone, we can see her taxation policy will mean that if she get elected, market may not react very well. Okay, so do watch out for this. Now, she also want to cut tax on the 100 million working and middle class Americans. And basically, she wants to do social engineering. She wants to give to the poor and take from the rich. And she wants to build 3 million more rental units and homes that are affordable. She wants to provide 25,000 in down payment assistance for first-time home buyers. She wants to provide forgivable 20,000 loan to Black entrepreneurs to start business. She wants to cut 50%, 50,000 tax on new businesses, small businesses, which is currently taxed at currently have a deduction at $5,000. She also wants to give families a 6,000 tax credit for newborns in the first year and to restore the pandemic era tax credit of $3,600 per child for middle and lower class families. She wants to ban price gouging on food, meaning to say that she don't know how she's going to implement that. And of course, she also wants to expand the earned income tax credit for workers in lower income jobs. You can see her social agenda are all geared towards helping or elevating the lower middle income groups. And definitely she had to figure out a way to pay for all these programs. And she thinks that raising taxes is a good idea. Like I said, the both initiative may not necessarily be congruent because on the one hand you are giving more to the underprivileged, and the other hand you are taxing the most productive sector of the economy. She want to get rid of taxes on tips, very, very similar to what Trump proposed to not tax on tips by service workers. Okay, she also want to expand subsidy for Affordable Care Act plan that could save an average $700 on healthcare insurance premium, and she also wants to create a framework for cryptocurrencies. So maybe she's taking a leaf off Donald Trump, at least for two items. One is to not tax on tips, as the other one is to create a framework for cryptocurrencies. And this was not something that Biden is actually angling for. So we can see the two candidates' agendas are very, very different. One is definitely more business friendly. The other one is not so much. Okay, I would guess that if Kamala get elected, businesses may actually find that it will be a disincentive to actually do business in the States. Okay, that may actually cause businesses to actually flow out to other places where the taxation policies are definitely more friendly. Okay, so based on their agenda, we can see that they do have very, very different outlook on what they want to do, given the fact that the economy is currently what we call in a soft landing scenario. Okay, whether or not we do get a soft landing, we do not know, but basically the narrative has been such. Now, when we look at the biggest elephant in the room, which is the US national debt, currently it is the last official number as far as the Federal Reserve is concerned. This is the data coming out from the Federal Reserve branch of St. Louis. The last update was in September the 5th. That means they say it is at least 2 months late. Okay, and last number was $34.8 trillion. And the latest number that I got, okay, from Peter and Peterson is October 30th, and that was $35.8 trillion. Okay, based on Trump's agenda, analysts think that he will add something like $7.75 trillion to the debt over a 10 years period. And that means by the year 2035, the national debt should be looking somewhere around $43.5 trillion. Again, like I said, this is on an upward trajectory that is totally unsustainable. At some point in the near future, we would have to deal with how US is going to deal with their national debt, because we are seeing foreign buyers are no longer buying as much, especially the number one, which is Japan. Japan has also been drawing down their holdings of US Treasury. And of course, China being the one at the receiving end of the economic war has been reducing their holdings of US Treasury over time. In fact, they have actually cut their holdings by half. Okay, so as we are speaking right now, there will be more a likelihood that the foreign buyers will be buying less. And if the US need to borrow more, there will come to a big question as to who they're going to sell it to. Okay, and not only that, they also have to contend with maybe offering higher yields to attract buyers. So all that is going to be a negative, because higher yields will lead to higher service costs. Okay, the interest cost of servicing this massive amount of mountain of debts. Okay, so this is the trajectory looking very unfriendly, and the way we look at it is that at some point we will have to deal with the sovereign debt crisis. Now, as far as Harris is concerned, this is her economic policy. Analysts believe that based on the current level of $35.8 trillion over a 10 years period, her spending will actually add to the national debt, but not by as much as Donald Trump. Is likely to be below $40 trillion, but still that is a big number. So we will have to see how this thing pans out. Like I say, the market has been pricing in a Donald Trump win, so we will see if that is going to be the case. Okay, and talking about the national debt, the biggest factor is that the US collected less in taxes relative to how much they want to spend on their various programs, especially on the war everywhere. We can see that the budget deficit is actually been actually quite wide. The widest was actually during the COVID-19, where they launched quantitative easing, and then they have created a lot of what we call helicopter money, and that is the case. And we can see that the budget deficit has again widened over the last 3 years, and now we are at the third highest in terms of the ability to collect taxes relative to what they must spend on. So the deficit is actually quite wide. Okay, as at the end of September, we can see it's up 8% to $138 billion from $1.7 trillion. So we can see that this is compared to a year ago, we can see that it has actually widened by quite a fair bit. And at this current rate, we probably will see higher and higher budget deficit. And if Trump gets into office, one of his key platform is to actually reduce taxes. So that will mean that there will be short-term pain. If Trump wins, the deficit is going to widen even further, because he is in favor of cutting taxes. And we all know the income from government is from taxation. If Trump's win, he intends to cut taxation. Hopefully can be compensated by the increase in tariff. But again, those two are not necessarily friendly in terms of how market will perceive the effect. Okay, then we can see that the federal spending versus their receipt, we can see that the gap is actually quite wide. $1.8 trillion deficit is actually quite wide. What they receive is only $5 trillion. What they spend is almost $7 trillion. So we can see there's a big gap, and this gap appears to be widening. Okay, and of course, a few factors comes into being. One is that the baby boomers that has been behind the economic miracle over the last 30, 40 years now are aging. They need to draw down on their what you call it, retirement benefits, and this is going to cause the healthcare to actually rise over time. And here we have a system in which the tax collection cannot match the amount of spending they need to spend on the various programs. So we can see this is the dilemma right now. Okay. Here we can see that the US Treasury borrowing, we can see that the borrowing has been continuing going higher. You can see that the curve actually exploded in 2008, and he has been climbing since then. Okay, so we can see that US Treasury having to borrow more to plug the hole in the budget deficit has now resulted in them borrowing as much as the latest number showed in August 24th, the borrowings by the US Treasury is at $26 trillion. So like I say, if they need to have more spending, especially if Donald Trump cuts taxes, that means to say the Treasury will have to make up the difference by borrowing, and that will be a problem because on the one hand, we have foreign buyers reducing their holdings. On the other hand, they will have to offer much higher yield to attract buyers. So by and large, when we look at the increased borrowing by the US Treasury, it is something that we will have to contend with at some point in the near future. Okay, this practice of borrowing with no limits is going to be problematic. And by the way, when we talk about having to raise the ceiling for the national debt, Biden did not solve the problem. He suspended the debt ceiling all the way until New Year's Day on January the 1st, 2025. So whoever wins the election on Tuesday, the first thing that they need to do is basically to either remove the cap or to raise the debt ceiling higher. Okay, so that will means the control over Congress is going to be very, very important. Most of us are focused on the US presidential election, but that is not the only election that is ongoing on Tuesday. On the other one that the media has not been talking a lot about is actually the control over the US Congress. Okay, so whoever control the Congress will have it easier if they want to push through the policy. Okay, now when we look at the Fed fund rate has actually been very high for 30 months from March of 2022 all the way to September 18, where the Federal Reserve reversed that very aggressive rate hike by cutting the Fed fund rate from 5.5% to 5%. Okay, so we can see the dip over here, but most market participants are hoping for more rate cuts. And for the last 2 months after the first rate cut, market was talking about maybe another 50 basis points for the month of November and another 50 basis points for the month of December, because we have 2 more FOMC meetings to go before the end of the year. But the numbers that come in, especially the September non-farm payroll numbers, has been so good that market now have to rethink their narrative. Okay, because if the economy is doing well, now remember GDP before the revision that we saw this past week from 3% to 2.8% was standing at 3%. So that means the economy is doing well, and then the labor market is also booming because we are seeing more jobs being created. However, that has been that bubble has been pricked on Friday, where we have only 12,000 jobs being created. Like I say, over time these numbers should come back to normal. But for now, the need for the Federal Reserve to cut rates again is obviously very evident because the labor market has shrunk by so much, whether it is due to the strike by Boeing or whether it is natural calamities in the form of hurricanes in the south. Okay, by and large, we can see that the latest non-farm payroll will actually give the Federal Reserve the cover to actually cut rates. Well, the market has already priced in the idea that they're going to cut 25 basis points the day after the election is over. By the way, the election is on Tuesday and Thursday and Friday, Wednesday and Thursday, especially Thursday on the 7th, the FOMC will meet, and we will know for sure whether there will be any rate cuts, and if there's going to be a rate cut, by how much. Market, like I said, has already priced in 25 basis point cut, and if the market did not get what they want, the market will go berserk. Okay, so most likely we will see a rate cut, but I think by 25 basis points, or whether or not we're going to get another cut in December remains to be seen. Okay, so this is where we are right now, but a lot of market participants cheer the fact that the Federal Reserve cut rate for the first time in 30 months. And that will assume that all other rates will also come down, because the Fed fund rate is actually the wholesale rate in which all other loan rates are based upon. So a lot of people are very optimistic that with the first rate cut, all the loans will get cheaper, but that is not necessarily the case, as we have seen in the numbers that follows after the September 18 rate cuts. Okay, here is the bond yield. Now, bond yield actually dipped lower to 3.618 just before the rate cut. And once the rate cut happened, you can see that the bond yield actually climbed. This is as of Friday. Now it is above 4%. 4.36% is the highest we have seen since August this year. So instead of rates going down, bond yield goes down, we have the bond yield actually exploded to the upside. And then on the other hand, you can see that there is this small insert here, the chart here called the US 30 years mortgage rate. That rate has also climbed from just above 6% before the rate cut. Now it's at 6.72%. So despite the 50 basis point rate cut in the Fed fund rate, the mortgage rate has actually climbed. So this is something that the market did not expect. Okay, so will this continue to climb? It looks like it may be the case. I think the bond market is pricing the fact that inflation is not defeated, and there will be very little scope for the Federal Reserve to be cutting. In fact, some analysts were saying that the Fed made a mistake by cutting 50 basis points. Okay, some are actually asking, saying that the Fed should actually be increasing rates rather than cut rates. So here we have a lot of contradiction over here, in which the Fed fund rates has been cut by 50 basis points, but the all-important US 10-year bond, okay, having to pay much higher yield, okay, to attract buyers. And we are definitely seeing at the retail level, mortgage rate is not coming down. In fact, it is actually climbing right after the Fed fund rate has been cut to 5% from 5.5%. So this is the reality on the ground here. And it is one of these reasons which I believe inflation may not go away. Like I said at the beginning of this presentation, if I'm the government, I will favor to have more inflation, because when I look at the national debt, one way to pay less in real term is to have inflation, very high inflation, so that you won't the real cost of financing the debt may be actually a lot lower. Okay, so earlier on I already mentioned, while all eyes are on the US presidential election, the other election that is also concurrently being held is the battle for Congress. Now, Congress is made up of two chambers. We have the House of Representatives and the Senate. Right now, both chambers of the legislative arm, which is the US Congress, is actually on razor edge. Okay, in the House of Representatives, which is controlled by the Republican, you can see that they do not control by a large margin. Okay, we have 222 against 212, which is what 10 members more than the opposition. Whereas the Senate is even worse. The Senate only have one vote more. Okay, one extra vote to the Democrats that controls the Senate. So while the US presidential election is being held, whoever wins, whichever party wins, ideally the party that wins the White House also wants to win both chambers of Congress. The benefit is obviously for the passing of policies. Okay, imagine if the outcome of the ballot for the Congress is as current as what we are seeing now, then it will be problematic, because everything that the White House wants to pass through in terms of policy may actually be stuck in terms of horse trading when it comes to the Senate, come to the Congress having to approve those policies. Then obviously, if the same party win the White House and also control both chambers of Congress, that will be the dream outcome. Okay. However, we all know how divided the US politicians are, and there is very good likelihood it is probably going to be more of the same. Okay, that means to say it will be in gridlock, and if both parties control one half of Congress, it will mean more gridlock, and whoever is residing in the White House will have problems getting their policy approved. But we have seen how Donald Trump has actually been using a lot of what we call executive orders, and I think President Biden has also learned that he can actually bypass Congress by actually signing what we call executive orders to bypass Congress. But that is not a very popular way of getting things done, because at the end of the day, Congress did not okay the policy. That means at some point in time, they will not be responsible for any ill effect of those executive orders. So here we have, while all eyes are watching the US presidential election, do also pay attention to the voting for the US Congress. Okay, if the worst comes, if one of the party win the White House but controls two chambers of the Congress, that will be a nightmare scenario in which the opposition will be in control of the Congress. That will be the ultimate no-no. That will mean the market will go into a spasm, because it will mean that there will be a lot of debt, we call it debt reckoning. Okay, so if this is the outcome where one party wins the White House, the other party wins both chambers of Congress, that will be a nightmare scenario, and the market will react violently. Okay, however, if the same party wins the White House and also win both chambers of Congress, the market will celebrate, because that will mean easy passage of policies. Okay, so we will have to see how things actually met out, but I think my guess is that it will be more of the same as it is currently being played out in Congress right now, where one party control only one half of the two chambers. Okay. Now, going into the coming week itself, of course, the first major event will be the US presidential election. It will be a whole day affair, and we will not know the answer maybe until the following morning on Wednesday. Okay, and then on Tuesday, we have the Chinese services PMI. No estimate here, but we have seen manufacturing PMI actually grew this past week. Okay, so that could be a good sign for Chinese services PMI. In Australia, the Reserve Bank of Australia would have to contend as to whether they will be cutting rates. Australia is definitely in deep recession right now. And if the central banks want to help the economy along, they possibly would have to cut rates sooner rather than later. But as far as this week is concerned, the consensus is that they will keep things as it is. No change here. Then we will be expecting the services PMI from the United States. We do expect a bit of a dip from just under 55 to 53.3. Then, of course, on the middle of the week, we have New Zealand reporting their labor reports. We have employment change. They also are likely to see a decrease in jobs creation, and also a corresponding uptick in the unemployment rate to 4.6 to 5%. So this will actually negatively impact the Kiwi dollars. So later on, when we talk about the Kiwi dollars, you have to understand that the current sentiment in New Zealand is actually not very, very good. The same can also be said of Australia. Okay, Australia on Thursday, we have the trade balance. Market expect them to see a dip in the total of trade balance from $5.64 billion Aussie to $5.24 billion Aussie. Okay, then we have the retail sales for Eurozone. No estimate here. Previously, for the month of August, it was 0.8. Then we have the Bank of England decision making. Market has already priced in a 25 basis point cut by the BOE. That will be on Thursday. This will be followed by the FOMC. Now, this, like I say, is going to be the 2 days after the results of the US presidential election is made known. So market do expect them to cut by 25 basis points from 5% to 4.75%. Then we'll be hearing from Canada about their labor reports. No estimates for both, whether in terms of their change in employment or the unemployment rate. Then they will be wrapped up by the Michigan Consumer Sentiment Index. Market do expect a bit of a dip from 70.5 to 70. So this is what we have for the coming week itself. Of course, the main event will be the election. So just be aware of the nature of this election. This election, whoever wins, I think it will still be chaotic, because nobody will accept the result, especially the party that loses the White House. They will definitely claim foul play has been done. And will that lead to a more serious January the 6th than the last time we saw? This time, I suspect it will be violent. I do expect some kind of civil unrest, because, like I say, no party will accept the result, and that will mean there will be contention in the post-election period, and that could lead to some kind of, I believe, some kind of civil unrest. And if that's the case, depending on how bad it is, that may eventually show up in equity markets. Okay, so just be aware. Okay, market may celebrate for a while, especially if it's a Donald Trump win, but reality will sink in very, very quickly, and that could actually undo all the goods if and should Donald Trump wins. Okay. And this is the price chart. I'm going to show you the weekly time frame for all the markets that I'll be talking about tonight. Okay, here we have the Dow Jones Industrial Average. We can see that 2 weeks ago, the Dow Jones actually picks out at 43,000 325. And last week, okay, we saw quite a bit of a sell-off from the all-time high, resulting in a bearish engulfing bar that happens in the weekly time frame. Now, the higher the time frame, the more relevant the reversal pattern. Okay, so bearish engulfing bar is definitely a very bearish development, and if it happens on the weekly time frame, okay, it will have significance. So do not ignore this sell-off that we saw the week before, and of course this week itself we have a bit of a also a minor sell. I think less than 2%, less than 1%, okay, relative to the close on the week before. So we can see the decline has actually has already started. Okay, we can see that the overall trend in the Dow Jones is still very, very bullish. The overall trend, the dominant trend is still up. We have what appears to be the making of a counter trend, which I think has already started, especially in a lower time frame. We can see that in the 1 hour, for example, the Dow Jones has already been, the dominant trend is already down. Okay, so we want to watch these movements here. There's a possibility that we may see further correction back to somewhere around the 39,000 levels, and that will be the most optimistic outcome. Okay, if we do have a pullback and the market stabilize eventually, and then we could possibly see the Dow Jones or overall US equity market climbing back up again. Okay, over the longer period of time, I do not believe we have seen the high in US equity markets, but for now, because this market has been looking at further rate cuts, and if that is the case, the market has already price in the likelihood of rate cuts. So if the rate cuts come in lower than expected or in a quantum that is not what the market wanted, the market could actually see a sell-off. Okay, so just be very, very aware that technically speaking, the Dow Jones is due for a pullback. Okay, if it does pullback, I think there is scope for the market to go back and test the 39,000, maybe to as low as 38,000. Okay, anywhere between 37,700 to 39,000 is going to be a bracket of prices which I'll be looking at should the decline continues unabated going forth. Okay, here we have the S&P 500. The S&P 500 actually picks out 3 weeks ago. Okay, so it actually hit a high 3 weeks ago. So this is definitely an earlier development compared to the Dow Jones. Right now, the Dow Jones is the strongest, but however, on the weekly time frame, we don't see any kind of classical reversal pattern just yet, although prices has come off since. Okay, it may actually be taking its cue from the Dow. So based on what we see so far, the overall dominant trend is still very much in favor of further upside. But for now, I think the market is right for a technical correction, and if the one actually develops, I think there is scope for the market to go down and test the 5,300 to as low as 5,000 levels. So very much similar to what I expect to see in the Dow. I do think that there is the possibility that the market may react to the downside regardless of who wins. Okay, then here the Nasdaq. The Nasdaq actually attempts to retake the all-time high, which was actually registered in July. So you can see the all-time high in Nasdaq actually peaks months ago. In fact, it peaks about 4 months ago. So we can see that as far as the Nasdaq 100 is concerned, it has led the bull run these 2 years. Okay, we can see the latest narrative has been everything related to AI has been brought up. So we can see Nasdaq actually has been leading the way higher until it picks up on July 11th, and the price has actually come off very sharply to as low as 17,239 from a high of 20,560 thereabout. So we can see that was a very, very, very deep sell-off, and of course that sell-off has got a lot to do with the sell-off in the Nikkei, which was incidentally due to the yen carry trade. So that has been more or less been digested by the market, and the Nasdaq 100 has actually rebounded very purposefully. And as of the beginning of the week, we can see that the Nasdaq actually hit a high of 20,649. Okay, not quite taking out the all-time high, and that came in with a bearish engulfing bar. Okay, so very much, although not as bearish looking as the one in the Dow, but it is still a bearish engulfing bar on a weekly time frame. So we have two major equity markets index that have shown reversal signal. The only one that has not clearly shown us a reversal signal is the S&P 500, but 2 out of 3 is already quite something. Okay, so I do believe the market is technically due for a pullback, and if we do have a pullback, there's a possibility that the low that we saw in August at 17,239 may be seen one more time, maybe even slightly marginally lower. Okay, I am expecting somewhere around 14,000 to 15,000. Between this bracket of prices, I think the market should be able to find a bottom, and that will be the most optimistic outcome. If the market can stabilize between 14 to 15,000, there is scope for a resumption of the bull market. Okay, but again, we will have to see what will be the catalyst at a particular point in time. For now, I think this market is where it should be. Okay, now in the currency market, we can see that the dollar has actually risen quite fairly against the yen. You can see that the yen has weakened despite the many rounds of FX intervention, which saw the dollar yen climb down from 162 all the way down to below 140. So we can see that was a 2,000 point, more than 2,000 pips move in the dollar yen. But since now, we can see that the market has recovered back something like 60% to a high of 155.9 this past week, and now it closes as a doji. On the weekly time frame, the appearance of this doji suggests that the market right now is uncertain which way to go. So if this is the case, if we look at the lower time frame, the moment we see weakness in dollar yen, there is a scope for the dollar yen to continue lower. And if that's the case, I think the fact is that if this is part of a classical pullback, then this pullback is by no means over, because there is no structure here. I would believe this bounce that we see from 139.5 all the way to 135.90 may actually be the second leg of a three-wave pullback here, targeting somewhere in the in this blue area here. That area will be at 126 all the way to 132. Okay, so there is a scope of that three-wave pullback over time. So whether that will be the case, we will have to watch. But right now, there is no sign that the dollar is weakening just yet. Okay, from dollar yen, at least we cannot see. And if the market goes back and re-challenge this bracket of prices between 157.60 to 162, I think that there is scope for the re-emergence of selling interest. I would believe the central banks in Japan may be tempted again to intervene, because I think that is the line in the sand which they have drawn. They do not want dollar yen to go beyond 162. Okay, so we can see 162 is where the last intervention occurred, and the market goes back and revisit this area here between 158 all the way to 162. There is the risk of intervention all over again. Now remember, the new prime minister in Japan, Ishiba, is actually a hawk. He actually favors the Bank of Japan actually normalizing interest rate. In fact, he favors hiking of interest rates. So if that's the case, there will be a case for the yen to strengthen at the expense of the dollar. Okay, so here we're going to watch either the market continue to edge higher into this bracket of prices between 157.60 to 162, and then meet a wall of seller and then come back down, or the market comes down from where it is right now as of the high at 153.90 and then starts to unravel. Again, we will have to take the lower time frame as Q. Okay. Here in dollar Swiss is not weak. Dollar Swiss, I believe the market has hit a bottom at 84 cents. Okay, 84 cents Swiss francs to the dollar. We can see that the dollar may be looking to strengthen, because right now we can see that the market has strengthened purposefully all these weeks here. You can see from the low of 84 cents thereabout, we can see that the dollar rate has been climbing. So here we have what appears to be a couple of bottoms here. Okay, it's not classical double bottom, but it looks like a double bottom to me. At the bare minimum, if this unfolds as a three-wave, it could be targeting the 93 cents to 95 cents level. Okay, so there's still a bit of a move up, a potential for the dollar Swiss to move higher. Okay, here we have the euro versus the dollar. Now, at the point whereby the dollar appears to be strengthening, we can see the principal currency has been unraveling. During the period over the last month and a half, we can see that the dollar has actually stabilized, okay, and it has been going higher. And a lot of that, I suspect, has got to do with capital inflow into the United States. We have seen at the beginning of October, whereby Iran actually attacked Israel by sending hundreds of missiles over into Israeli territory, and the Israelis has actually retaliated last Saturday, and all this tension is leading to capital fleeing for safe haven, and I suspect a lot of those money has actually flown into the United States, and that has actually buoyed the dollar, and that has also in turn supported the Dow, okay, until recently. So this move in the dollar upwards may actually be still ongoing. However, here we are seeing that the principal currency has all pulled back. We can see the euro dollar did attempt to go and challenge the previous high here at 112.75. Did not quite make it. The high traded was actually a month and a half ago at 112.14, and the market has unraveled. And although this week we have a bit of a bounce, but I think it is still very tentative. I think the trajectory do suggest that the euro may continue to weaken going forward, especially if the ECB is going to be cutting rates when they next meet. So all this is a perfect storm, whereby I think the principal currency will all be coming off, and at the expense whereby the dollar may actually benefit from more capital flow into the United States. Okay, here, technically speaking, there is scope for the euro dollar to do the three-wave pullback here to all the way to test the 104 levels. So I think 104 is very achievable based on where the market closed on Friday at 108. We can see that it's still about 400 pips before the market can hit its target. So I think there is scope for further losses in the principal currency, in particularly the euro versus the dollar. Okay, sterling is the same thing. Sterling has also lost quite a fair bit, although year to date it is still positive, unlike the euro dollar has rated negative year to date. And we can see that the sterling has actually went up to a high of 134.34 before it loses steam. So from the high to where the market closes on Friday at 129.20, we can see that the market has lost almost 500 pips, and it does not look like the end of it. So I believe going forward, the strength in the dollar may actually see sterling also coming under pressure. Now, we also saw this week how the Chancellor of the Exchequer, which is the finance minister for the UK, has proposed hiking taxation, okay? And this is definitely something that you do not want to do. Now, remember this trust that Prime Minister that lasted for the shortest possible time in history. His finance minister also suggests the same thing, and we can see what happened to the gilt, which is the UK bonds, okay? And that has actually took a nosedive when the budget was released by this Chancellor of the Exchequer, asking for more higher taxation to pay for these spending. Now, in the budget that she presented, there was no mention of cutting spending. So this has been quite the same thing that we saw across all Western governments of late, especially the G7, whereby governments has been spending like crazy with no regards for cutting spending, but they found that the budget deficit cannot be breached, and they wanted, they all find the easiest of solution, which is to tax the population, tax businesses, tax the rich, and this is definitely the most productive part of the population. And if you actually give them this incentive to be doing business in your own country because of high taxation, capital will find a place whereby they are welcome. Okay, so over time, higher taxation will lead to an erosion of business confidence, and definitely the creation of jobs will also be impacted negatively, because if businesses pull out and relocate somewhere else, they take along with them the jobs. Okay, so this is the situation. If the taxation actually it's been approved, okay, by the UK Parliament, that means to say that the pressure on the sterling will be actually quite immense, okay? That will put a downward pressure on the sterling itself. So going forward, technically, we are seeing the sterling has been falling for 5 weeks in a row, okay, with no breaks, and this may actually accelerate as the months goes by, okay? Here in the Aussie is also in trouble, although Aussie right now is in a bit of a consolidation. We can see the market hit a low of 61 cents and then bounced up to 71 cents, and it has been consolidating somewhere between 61 cents and 70 cents. Okay, the highest traded recently was 69.5 cents before it also loses traction and started to fall for 6 weeks in a row. Okay, based on what we have seen so far, there is the possibility we will see further weakness in Aussie. Now, in Australia, we can see that the cafe culture, anyone of us who have gone to Australia will have actually seen how vibrant the cafe culture is, but that is also now becoming the victim of the recession that we are seeing in Down Under. Okay, and that is definitely a sign that things are not doing well. Okay, the property market is definitely a big drag on the economy, and definitely the student population, overseas student, has also declined, which will lead to a funding problem for the university over there. And we can see that overall, by and large, you can see Australian economy is definitely suffering, and that should also reflect in the currency rates. Currently, the market closed at 65 cents thereabout, and there's scope for the market to do a three-way pullback all the way targeting 60 cents. Okay, so there is still a bit of a room downwards, maybe another 500 over pips before the market can stabilize. But by and large, I do expect this low here at 61 cents to be challenged over time. So I'm a little bit bearish on all currencies other than the dollar. Okay. So the Kiwi dollar is also in trouble because the Kiwi economy is also suffering. In fact, the Kiwis are actually finding jobs hard to come by. A lot of Kiwis are actually migrating to Australia. It's as good as jumping from the pot into the fire because both economies are not doing great right now. And this is also something that we have to watch. The Kiwi is definitely coming down, and we have seen the central banks has been cutting interest rate very aggressively, and that will be a negative for their currency. So the Kiwi will definitely be on the back foot, and as times goes by, I do believe this pullback that we see all the way from 65 cents may actually see a challenge of the 55 cents over time. Okay, so watch out for this 55 cents level. I think there's a possibility at the bare minimum 56 cents to the dollar may be seen in the Kiwi over time. This is something that I want to talk about very, very interestingly, because gold has hit the all-time high of $2,790 and then a touch better in the middle of the week. Okay, so this is the highest we have ever seen spot gold being traded. Of course, there is a bit of a premium relative to what the COMEX has been doing. You can see that the market ends as a long-legged shadow doji. Now, this is a classical reversal signal, and happening on the weekly time frame, it is to me very, very significant. Okay, I have reason to believe that the top may already be in. Now, going into this week trading, I have been mentioned during, especially last week, that I suspect the last day of October could see the top in gold. And true enough, gold came in on 31st of October, and the high was 2,790 and then 09 cents. Okay, and here there is possibility we may see the top already in place for gold. Okay, especially if Donald Trump wins the election. Donald Trump being an anti-war individual, he already claims that he can end the war on the first day of his new administration, and that will definitely be a dampener for gold. Okay, so if Donald Trump wins, there's a very good chance that gold may actually retreat. Okay, so just watch out how this gold market will trade over the coming weeks, leading all the way to the inauguration. Assuming Donald Trump wins, his inauguration will be somewhere in the middle of January. And from now until January, hopefully nothing much happen. If something happens, again, obviously, this narrative will be thrown out the window. But if assuming that nothing untowards happened, okay, untowards happened means to say that if Biden did not start a new war before the handover, for example, okay, if the war in Ukraine or the war in the Middle East do not suddenly flare up big time, okay? Meaning to say that if a war actually happens beyond the borders of Ukraine, or it spills out or between Iran and Israel, for example, then when Donald Trump comes in, if assuming he wins, that means he will not be in a position to stop that war. Then obviously this narrative of lower gold prices would not work. But assuming that it's not the case, then I think all said and done, okay, I think there's a good chance for gold to actually top out at 2,790 for now, okay? And I do believe over time, gold prices is going to go a lot higher. But for now, I think the market is due for what looks to be potentially a technical pullback. And if one should happen, I think the area between 2,340 to 2,500 is going to be a level which I'll be comfortable to re-engage the markets. Okay, so for now, do not chase gold. Okay, if there's going to be a pullback, there'll be cheaper price to buy gold. And I think buying gold is something that we all have to consider because things are not the same anymore. Currencies are not going to be the monetary system around the world is not going to be the same. A lot of things going to change, and I think a lot of that was going to pivot to safety. Okay, and gold has always been able to play out as the asset that actually can hold value over time. Okay, so holding on to precious metal is something that we have to consider. Okay, so there you have it. I think the top is possibly in place, and I'm looking at lower prices. Whether you can sell this gold is open to debate, okay, because the market is a very, very aggressively bullish market. Okay, so if you do not want to sell like I do, then maybe what we want to do is wait for the price to drift lower, okay, and then look at this market from the long side rather than a short side. Okay, and silver is also seeing something very similar. Now, silver actually picks out at $34.85 the week before. Okay, so we can see the market ended the week before with a doji. And this is, again, a sign that the market is no longer sure which way to head. And this week follows by a massive sell down in the silver. Now, we also heard reports that 5 American banks are heavily short silver. Okay, for some reason, they want to cap the price of silver. Okay, either at the behest of the US industrial military complex, because a lot of silver goes into the manufacturing of weapons. And if that's the case, then obviously it will make sense to cap the price of silver. And that has been the case. But silver prices has rallied so much now that we have this new development over the last 2 weeks. There is scope for further pullback in the silver market. And if one actually happens, there's a lot of bottoms here. You can see a string of areas in which we have 5 support previously. The nearest one is $30 per ounce, followed by $27, followed by $26, followed by $24. So all the ladder downwards are area where the market has been supported previously. But I think on the logical basis, the market can pull back something like 38.2%, which is going to be $28 thereabout. I think that will be a good area to reconsider if there's going to be enough demand. Okay, but I think by and large, I think the demand has been there. So long as the war is still present in the year 2025 onwards, I think the demand for silver will also be there. Okay, so by and large, I'm not suggesting that you sell the gold or silver markets, but instead to wait for the market to drift lower and to consider repositioning on the long side should that actually happens. Okay. Now, oil is something else. Okay, oil. Right now we can see that now before 2009, for example, US wasn't a large energy exporter. Okay, but the emergence of fracking, okay, has allowed the United States to be the largest energy exporter. Now, just know that in US itself, there has been no major refinery being built over the last few decades. Most of the oil are being refined, and they also have been buying a lot of oil from Venezuela. Now, the Venezuelan oils are very different in chemical composition. They are heavy, meaning they don't flow as easily as other grades of crude oil, and it has a very high sulfur content. So the refineries in the United States are geared towards refining the heavy crude oil and those with very high sulfur content. So they have no reason to actually invest in building large refineries, because the talks of late, ever since Biden became the president, it has been towards a greener and a cleaner environment. So it doesn't pay to invest in a sector whereby it goes against the administration stated green policy. So there has been very little to no investment in building new refineries. So the current refineries in the States are actually refining the heavy sulfur-laden crude oil that they actually have. Okay, but so what the US does instead of building new refinery to refine the new oil from fracking, the US oil manufacturers, oil producers find easier to actually export the American shale oil. Okay, so while the US produce a lot of oil, they also export a lot of oil, and this is causing the OPEC Plus to be losing some kind of influence. Previously, before the US comes into the picture as a major oil producer, OPEC Plus is a force to be reckoned with, okay? But not so much of late because the US now is playing the part of a spoiler, okay? They have been flooding the energy markets with their more efficient shale oil, okay? And that has actually dampened the supply, okay? Supply has actually become more in a market whereby the biggest buyer of oil is China. China is buying less because the economy is struggling, so they have less need to import oil. So all this is leading to a mismatch. We have more supply coming on stream, whereas demand has not necessarily caught up. Okay, so here we see oil prices has been declining, and it has been a pattern. But when we look at the chart itself, we can see that WTI, which is the West Texas Intermediate crude oil, okay, has been more or less finding a bottom around the 64 cents, $64. So you can see last year, $64 seems to be the holding out. And this year, the lowest price traded was in August at $64.75. The market did bounce a little bit, but again, it is struggling. So what I do see here is possibly an accumulation of prices. So if anything else, this looks like a double bottom to me. So I think the potential for upside revision in prices has always been there. However, that being said, if the price of crude oil goes below $57, of course, a new pattern is going to emerge. Of course, this bullish outlook will not be in play. But right now, I'm actually long the WTI, hoping for a rebound to challenge the 94 cents. Hopefully, can go even higher to 94 cents, $94.60 to $100 thereabout. So I am holding on to a position which I think over time may see the rebound in oil prices, especially if there's going to be an escalation in the geopolitics. So this is something that I want to be positioned for because I believe over a longer period of time, oil prices is going to be worth a lot more. Okay, so by and large, this is what I see so far. Okay, so this is a misnomer. This one should be the Bitcoin. I didn't change the title here. Now, Bitcoin did a challenge of the all-time high. We all know the all-time high in Bitcoin is at 73,767. Okay, this week itself, we saw a challenge at 73,600, and then it failed. Now, the market obviously has not closed. Okay, as of this afternoon, this is what I see. This is happening, what we call a pin bar. A pin bar happening on a weekly time frame is big to me, okay? Because this is a classical reversal pattern, okay? That means to say that if Donald Trump wins, Bitcoin may actually explode to the upside, okay? But the market has a change of heart right now based on the idea that the market failed to break out above the all-time high, and that has seen prices come down all the way to 68,000 this afternoon. Okay, so if this continue all the way to, let's say, midnight, and the market closed like this, okay, tomorrow when the market opens, I think it's higher to sell. Okay, so if this is the case, it is still technically possible for the market to do a three-wave to challenge this low here at 49,000. So this price at 49,000 may be seen one more time before the market stabilizes. By and large, I'm bullish on Bitcoin. Okay, structurally speaking, the market has been in the bull market since 2022, and this looks like to be another case in which the consolidation is larger and wider than expected. So if the market do pull back from where we are right now at 68,500, there's scope for further lower prices in the Bitcoin, ideally to test the 49,000. In fact, much better area will be within this blue area, but let's deal with it if and when it comes. Okay, so this will be my outlook for the various markets. Now, remember, I am currently based in Kuala Lumpur, and I will be doing a 2 days webinar together with IronFX in Penang this time. And this is the registration link. This will be a physical event. So what I'll be doing in the 2 days, on Sunday afternoon, I'll be sharing with you the macro outlook of the markets, followed by 2 hours of sharing of my foundational strategy. Okay, and then this will be followed up by Monday evening when we do a live trading. It will be very important for you to not only come for the live trading, but to also come for the first day session, in which if you don't understand why I do what I do, then come to the live trading, it may not work as well for you. Okay, so I would seriously encourage those who are in Penang or coming to Penang to actually sign up for this. We have very limited seating arrangement here. I think the most we can take is 18. Okay, so spots are quite limited. If you are interested or going to be in Penang during this period of time between November 17 to 18, do drop by. If anything, we can have a coffee and we can talk shop. Okay, so if you are keen to register, the place will be at Amari Spice Hotel in Penang, very near where the Snake Temple is, I believe. Okay, so if you are keen, do sign up for this. Stocks are quite limited. Practically only 18. We can only take in 18. Okay, so it's a small area, so we will want to keep it very cozy. Okay, so anything that you want to ask me, you have to ask me now. Any question at all? Okay, here David is asking, the US election could be highly uncertain. That is true. Expect the unexpected is going to be the buzzword here. As both parties may contest the results, I fully expect them to contest the results, and no one will accept the final result, by the way. Okay, this situation could lead to unrest and possibly drive up the price of gold and other precious metal. What are my thoughts on this? It all depends. Okay, gold reacts more to geopolitics rather than domestic politics. So I think the impact on precious metal may not be as impactful as compared to, let's say, an escalation in the geopolitics in Europe or in the Middle East. Okay, I think the short-term answer to your question is that I do not expect material impact on precious metal as a result of the contest or the over the results of the election. Here, Raja Kumar is asking, when is the rate cut expected for Euro? They just recently have a rate cut, so I think the next month will be the one. Okay, so look out for December now for the next rate cut window. Okay, for this is referring to the Euro, by the way. Okay, any other question that you want to ask me? Anything? All right, if there's nothing else, for those who want a recording, just know that it will take at least 48 hours before I get an update on the recording. So if you are keen to get a copy of the recording, reach out to me by WhatsApp, and I will see what I can do. Okay, and then again, once again, I will see you on Sunday, next Sunday, and until then, thank you very much, and do watch out for the very exciting US presidential election. Bye for now. Bye-bye.